Hey everyone, welcome back to Corporate Decoder, the place where we unpack the secrets hidden inside corporate filings. Today, we're diving into a deal that could make or break ESH Acquisition Corp, a company that seems to be playing a long game with a fitness brand. Stick around because this report might just reveal a few more reps than we expected. Alright, let's get straight into it. We're re-looking at a fascinating Form 8K filing from ESH Acquisition Corp. This is INS T, your typical quarterly report. This is about a significant business combination. Think of it as a merger announcement, but with all the legal nuts and bolts that go with it. The date here is the 15th of September 2025. This is the key date when ESH Acquisition Corp, or ESH as they call it, officially entered into a business combination agreement. Now, who are they combining with? They're joining forces with the original Fit Factory Ltd, which we'll call TOF. This sounds like a fitness company, and based on the name, I'm guessing it is all about workouts and maybe even some wearable tech. To make this happen, ESH is also bringing in some other entities, the original Fit Factory Holdings Inc., and a subsidiary called the Original Fit Factory Acquisition Inc. This is pretty standard for these kinds of deals, creating a new structure for the combined business. So what is the plan? Essentially, Merger Sub, that subsidiary we just mentioned, is going to merge with ESH. ESH will then become a part of this new structure owned by the Fit Factory company, Pubco. This means that ESH, which started as a special purpose acquisition company, or SPAC, is essentially being acquired by TOF, creating a new publicly traded company. The deal involves shares of something called Pubco common stock. For every share of ESH class of common stock you own, you'll get one share of this new Pubco common stock. It is like swapping your old ticket for a new one in the combined entity. Now, here is a crucial detail about TOF shareholders. After some shuffling and a reverse share split, they end up with a total of 50 million shares of Pubco common stock. This sets a baseline for how the ownership will be structured after the deal. Let's talk about the money. Pubco is going to pay TOF as shareholders with newly issued shares. The total value of these shares will be $500 million, and they're revaluing each share at $10. This tells us the expected valuation for the combined company. But there is a catch, or rather some conditions that could change the deal. A big part of this involves what they call company performance conditions. For ESH's sponsor to not have some of their founder shares cancelled, TOF needs to hit some targets. One of these is an EBITDA condition. Now, EBITDA is basically earnings before a few big expenses like interest, taxes, depreciation, and amortization. It is a way companies measure their operating performance. For TOF to meet this condition by the end of 2025, their consolidated EBITDA needs to be at least $9,121,692. That is a specific financial target. Another condition is related to fundraising. TOF needs to raise at least $20 million through something called transaction financings. This means they need to bring in new money, likely from investors, to support the deal. If they don't hit the EBITDA target, they can use a different method, like an equity line of credit. There is also a performance kicker. If the value of Pubco S stock stays above $12.5 for a certain number of days within a 30-day trading period within a year after the deal closes. TOF S shareholders might get some bonus shares, essentially for free. This is an incentive to keep the stock price up post-merger. Now, the agreement includes terms around what constitutes a SPAC material adverse effect. This basically means any event that could stop ESH from completing the deal. It is a standard clause to protect against major unforeseen problems. Similarly, there is a company group material adverse effect, which refers to anything that could significantly harm TOF's business or its ability to close the deal. These clauses are important because they define specific scenarios where the deal might be renegotiated or even called off. An interesting point here is that the promises and assurances called representations and warranties made in the agreement will expire once the deal is done. This means after closing, the parties generally can't go back and sue each other for something said in those promises. It is a what happens at closing stays at closing situation for those specific assurances. During the period between signing the deal and actually closing it, both ESH and TOF have to run their businesses as usual. They need to operate in what is called the ordinary course of business. This prevents either side from making drastic changes that could affect the value of the combined company before the deal is finalized. A key task before closing is making sure the new company Pubco gets its stock listed on a major exchange, like the Nasdaq. This is what makes the company publicly traded and allows its shares to be bought and sold by investors. ESH is also arranging to raise about $2.5 million to cover transaction expenses. This is the money needed to pay for the lawyers, bankers, and other costs associated with making this this big merger happen. This part reiterates the flexibility for TOF. If they can't hit that EBITDA target, they still have options to get the funding needed, like setting up an agreement for future stock sales. For ESH to be obligated to close the deal, TOF needs to ensure all employment agreements are in place and valid at the time of the merger. This is crucial for maintaining the operational team after the deal is done. There is a deadline for this whole operation. If the merger doesn't happen by the 30th of April 2026, either ESH or TOF can walk away. SPAC deals often have these deadlines to ensure they don't drag on forever. ESH also has the right to terminate the agreement if TOF experiences a significant negative event that isn't fixed. This is another protective clause for the buyer. This is a common clause in SPAC deals. TOF and its related parties are essentially saying they won't try to claim any of the money ESH raised in its initial public offering that is held in a trust account. This money is usually meant for the shareholders if the deal doesn't go through. To ensure TOF shareholders are on board, some of the biggest ones have signed a company shareholder commitment agreement. They're agreeing to exchange their shares and are even using a drag-along option, which essentially forces all other shareholders to go along with the deal if the majority agree. Similarly, ESH's sponsor, the entity that helped set up ESH, has signed a sponsor support agreement. They're agreeing to vote their shares in favor of the deal, and promise not to sell their shares until the deal is done, with some exceptions. Certain major sellers are also signing lock-up agreements. This means they can't sell the shares they receive from the merger for 6 months after the deal closes. It is designed to prevent a flood of new shares hitting the market immediately, which could drive down the stock price. And to protect the new company, key sellers are also agreeing not to compete with TOF or solicit its employees and customers for 2 years after the merger. This is crucial for the ongoing success of the business. Finally, there is an agreement about registering shares for sale. This means that when the time is right, the new company will help its shareholders officially register their shares with the SE, making it easier for them to sell them. This clause basically means that if something goes wrong because of a party's mistake, they have to cover the costs and damages for the others involved. It is a way to manage risk and ensure accountability within the agreement. This part refers to warrants, which are like options to buy shares at a certain price. This agreement is about how those warrants will be handled and transferred as part of the merger. This section is about who might be influencing ESH's shareholders to vote for this deal. It is a disclosure requirement, making sure investors know who has a stake in the outcome. And of course, no corporate filing is complete without a cautionary note regarding forward-looking statements. This is a legal disclaimer telling investors that predictions about the future might not come true and that they shouldn't rely solely on these statements. They're basically saying, we hope this works out, but no promises. This is the final piece, the interactive data file. It is a standardized way to present information so that computers and the CC can easily read and process it. So, what is the story here? ESH Acquisition Corp is merging with the original Fit Factory, a fitness company. The deal values the combined entity at $500 million. Key conditions include financial targets for TOF, like a certain level of earnings and fundraising. There are also lock-up agreements to prevent immediate selling of shares, and non-compete clauses to protect the business. Both parent companies will work to ensure the new publico is listed on a stock exchange. The success hinges on TOF meeting certain financial milestones and stock performance, with potential bonuses for shareholders if the stock price performs well. Now, for my take, this is a classic SPAC deal where a company like TOF is going public by merging with a cash-rich SPAC ESH. The valuation seems reasonable for a company in the fitness tech space, assuming TOF has solid growth potential. The performance conditions, especially the EBITDA target, are critical. If TOF can meet them, it suggests operational strength. If not, it raises questions about their ability to manage finances and achieve their goals. The lock-up periods and non-compete clauses are standard practice and show an effort to stabilize the post-merger company. However, the success ultimately depends on TOF execution in a competitive market. Investors should really pay attention to how TOF performs against those EBITDA targets in the market. S reaction to the Pubco stock post. Listing. Without knowing TOF's current financials beyond what is hinted here, it is hard to say for sure if this is a slam dunk, but the structure is sound if TOF can deliver. Alright, that is our breakdown of ESH Acquisition Corp. ESH's latest filing. What is your take on this fitness merger and the conditions attached? Do you think TOF can hit those targets? Drop your thoughts in the comments below. If you found this deep dive helpful, please hit that like button and subscribe for more corporate decoding. And don't forget to join our Discord community, linked in the description, for more discussions and to connect with fellow analysts. Thanks for watching, and I'll see you in the next one.